Hey everyone, welcome to another episode of The Remote Real Estate Investor. I'm Michael Albaum, and today I'm joined by Kori Covrigaru with PlanOmatic, and he's returning to the podcast, not to talk about PlanOmatic, but actually to talk about what he's doing as a remote investor in the single-family rental space with his fund that he started with some buddies. So let's get into it. Kori, what's going on, man? Welcome back to the podcast. Thanks for taking the time to hang out with me.
Always excited, Michael.
Dude, this is going to be a lot of fun. So the last time we had you on, we were talking about your company, PlanOmatic. And for anyone who missed the episode, give us the quick and dirty. What is it that you all do and how you're disrupting the industry?
We helped at the beginning of this industry. So back in 2012, we started out with the SFR industry, but PlanOmatic creates professional photos, floor plans in 3D for the single family industry at speed and scale nationwide. So that's what we do, plain and simple. We are the boots on the ground that go out, take professional photos, do 3D scans, export floor plans from that, and then deliver that media to our customers. We try to do it under 2.5 days, and we're pretty damn close to it. So that's what we've been doing. We help these REITs, institutional investors, and smaller companies scale from 5,000 properties all the way up to hundreds of thousands. That's our business. That's what we're here for.
Amazing. And today, you and I are here to talk about something a little bit different, kind of related, but really it's about your journey in the SFR space as a remote investor.
Yes, sir. So, just being in this industry for so long, I'm surprised it took me so long to decide to get involved on a higher level. But yeah, I've been just watching, myself and some people that I work with here and some family and friends outside of here have been watching this SFR industry grow to the level that it has and never really gotten involved on the investor side. I mean, I had rentals on my own. I've had a rental, my first rental I bought with my business partners. I want to say it was 2006. I think it was October 2006 or 2005. And we bought a rental out in Grand Rapids, Michigan. Since then, we exited that. Then I had a couple rentals here in Denver, but nothing remote and nothing to the level of what we're building right now with SFR Emo. That's the name of the partnership, the group that we've established. We're 13 partners. And we all threw in some cash and have been acquiring homes, single-family homes for residents to live in Alabama, of all places, Birmingham, Alabama. So that's what we've been doing. Yeah.
Interesting. So you've done the local investing, to you in Colorado. So what did you eat? What did you drink that decided, hey, I'm going to go do this crazy thing and invest where I don't live?
I ate and drank reports for where our customers were buying real estate and where it made sense, and just reading articles. I mean, there's so many great content distributors, you guys included, in terms of what markets make the most sense, what to look for in a market. And so I have been immersed in all of this data and all of this information for so long that I finally pulled the trigger and said, hey, time to form a partnership. We started out with 5 partners. That was the deal. It was going to be 5 partners, no more. And then, I don't know if you've ever been involved in something like this, but what happens is you start getting phone calls from random people saying, hey, I heard you got this thing going on. Like, I want in. Why didn't you invite me? And it's like, well, hold on a second. Like, first of all, I don't know how you found out. And second, like, it's this really small thing we're doing. And so it went from like 5 partners to 13. And then we had to cut the investor pool out at that point and build with what we have right now, because we still haven't, deployed all the capital. So I'm starting to understand why we see billions of dollars come into the industry committed to buying SFRs, but it's very slow to deploy. And so we're experiencing that right now. I mean, we're not slow to deploy, but it takes some time. And so that's kind of how the idea started. Yeah. Just get involved. Eat your own dog food, as they say, I think, right? That's the term.
That's it. So, Kori, I mean, you just went through, I think, what so many newer investors really struggle with, and that's picking a market.
Yeah.
And talk to us what are these reports showing? What were they telling you? And also, like, how did you settle on Birmingham? Because I'm sure the reports show that there were really a lot of other great markets to invest in too, yeah?
Yeah, I mean, we landed, I'll cut to the chase, then I'll kind of backtrack a little bit. But we went with Birmingham because this is a small partnership and we really didn't want to have to continue to put money in. So we wanted to pick a market that could cash flow. We wanted to pick a market that was cash flow positive, had great cap rates. relatively speaking. I mean, cap rates are being compressed everywhere right now. As we know, cost of capital is going up. Prices of homes are going up. That's actually going to reverse here pretty soon, in my opinion. We can get into that later. But so we picked Birmingham. There was a lot of economic opportunity being created there, jobs being created there, but also we knew we were going to be cash flow positive with the cap rates, and there was room for appreciation. Plus, we found a really great property management company partner that we work with down there that can not only service us in that market, but we can also expand to other markets. With their support. So those are the reasons, the main reasons why. I mean, we at PlanOmatic have the advantage. We have a critical mass of single family rentals that come in through our pipeline to shoot photos, create floor plans, 3D. And so we kind of have like this holistic view and indicator of what markets might pop off next. And we use that data to make decisions for SFRM on where to invest. It's a bit of an advantage that not most have, but I'll tell you what, all that data is public. I mean, we can go out there and see and look at county records and see where all the institutional landlords, all the professionally managed properties are being bought. And so if you dig data or like to, you can always go on Upwork or Fiverr and say, hey, please go find me this set of data. Those are kind of hacks that you can do to figure out where companies are buying. Now, just because professionally managed companies are buying there doesn't necessarily mean it's a home run. You have to do your own research, figure out what your goals are with your portfolio, where you want to start. So that's kind of been our trajectory on the direction and where to own and operate for us.
Yeah. And that makes a ton of sense. And I love that you said that too, like go find someone else who can kind of help aggregate the data or figure out the data for you. Because you don't have to be the person to do all of the due diligence. You don't have to be the person to do all of the research. And also you can leverage other companies' paid employees, like you were just mentioning. If an Amazon fulfillment center is going in there, or like Whole Foods is setting up their new headquarters there, they've done the research. Yeah. So of course you've got to validate it for yourself. Don't reinvent the wheel.
Right.
Yeah.
It's out there.
Okay, I love it.
It's out there.
Okay, so Birmingham was the target. Yep. What did you all do next? I mean, how are you executing there? I know you said you had a great property manager, but from the physical property acquisition to due diligence, there's so much more involved before you even own the property. How did you get that accomplished?
Yeah, so this idea came about at some point in 2020 when shit hit the fan and COVID was on the way. And in my mind, and I've always been fairly wrong when it comes to trying to predict the market. The only thing the only thing that's kept me successful is that there is no bad time to buy. That's just my mentality. Like there is no bad time to buy. It's just a matter of how you go about finding those properties and what you do during negotiation and due diligence. But back in 2020, we said, the real estate market's going to absolutely flop right now. Nobody's got jobs. The unemployment's going to be crazy. We're headed into this, doom and gloom period, which is of course very wrong. And we said, it's a good time to buy single family rentals. Rentals, they perform regardless of economic conditions. Typically in recessionary periods, they still grow, not as fast, but they do grow. That's a hedge against inflation, so on and so forth. And so we decided to form the entity. Again, went from 5 to 13 very quickly. But between mid 2020 and mid 2021, I don't think we purchased a single property. And so, we had to go through all kinds of processes, right? You have to have a good operating agreement. You have to establish an EIN number. You have to select a property management company. You have to make sure you're filing the right tax forms. You need to find a broker. You need to do research and figure out where you want to go. I mean, that was a big, chunk of our time was we didn't know in 2020 exactly where we wanted to go. So we had to do that research. We had to have, make sure that all the partners were kind of on board. And then at some point in time, we decided that, hey, these 3 partners or 5 partners are actually going to make the decisions. Okay, now we have to amend the operating agreement that requires lawyers again. I mean, we kind of did a lot of stuff makeshift, but there's a lot to do. And a lot of time to be had between the moment where you decide, hey, I'm going to get into this, especially if you're remote, and we just closed on our first property, right? So it's more than you expect, but doing it right is the most important thing, and I think we've done it right so far. We learned a lot, along the way, but we're on the right track. I mean, we're almost at we'll be at 28 single family homes. And that's the course of a year, right? So from mid 2020 to 21, we didn't purchase a single home. In the last 12 months, we've purchased approximately 28 single family homes.
Oh, that's so killer. So, Kori, I mean, I'm curious to know too, why did you not just do this alone? a lot of people would argue, well, wow, 13 people, like that's way too many cooks in the kitchen, or 5 people making decisions. Like it can get very convoluted, very crowded very quickly. Wouldn't a single operator be more lean and be able to move quicker?
Yes. I mean, well, so the short answer to that is I can't really do anything. I have a lot of really good ideas, but I can't do much. So that's why I didn't go at it alone.
Yeah.
Yeah, I'm the idea guy.
Right.
I need people around me to do things. But no, I mean, one big reason why we went with more is just to have more capital, to be able to diversify more. It's risky as an individual to go out and buy 1 or 2 rentals. But if you go out with a group and buy, our goal is to hit 60, that's a pretty diverse portfolio and minimizes risk. And there are a lot of great minds in our partnership. I mean, we have a finance guy, right? We have a data guy. We have a consultant who's seen many different organizations. We have myself who's kind of like overall seeing the organization from a high level and helping with the financing part of things. So I think it helps to have different people. Plus, this is all, passive for us, right? Everybody's got a full-time job. And so, if I were to do this alone, this would be a full-time job, no doubt. But spreading it across, having the right property management company, but this person doing, diligence, and this person negotiating offers, and this person making sure our bookkeeping and finance and taxes are all in line, it just helps kind of spread that out.
Yeah, that makes a ton
Plus,
of
it's
sense.
fun, man. It's more fun to succeed with partners. Like, I have 2 business partners here at PlanOmatic, and I couldn't imagine being a sole proprietor. It just doesn't seem as fun to me. Like for us, it's always been the game and the chase and like winning the game. And it's if you're by yourself winning and celebrating, that's not fun. And same goes with the lows. I mean, 2020 was a tough year, right? And so having the support of business partners helps. So I just think it's more fun.
Yeah, that makes a ton of sense. I'm curious, Kori, how did you figure out like who does what? And when you were picking your partners and picking your team, what was the process that you went through to do that? Because I think a lot of people are like, oh, my best friend, we're so alike, we're so similar, we think the same, we should be partners, we should be business partners. Was that kind of the case for you?
For me, I mean, I kind of surround myself with people that are like-minded and sort of see things, in a certain lens when it comes to opportunity, right? So it was pretty simple. It was more like who do we not tell, and ask versus who, because a lot of people came to us, a lot of really good friends. So it was just who's willing to take an opportunity, who trust. I think trust is the number one thing when it comes to partnerships, is like, is there trust? So we had to make sure there was trust there. And then different specialties from different people. Again, like I said, like one guy is a full-time controller at a big company. That's really helpful. Another guy is an operations guy who's operating, we're shooting 500 to 700 listings a day, right? So like that really helps play into it. One of our guys, Tim Rose, he heads Plano Labs, and we analyze and optimize workflows and analyze and optimize reports and data just based on what's coming in. And so having him on board to help us decide which market to go with or what cap rates to focus on, I mean, that was helpful. So it kind of, this one all came together. And then the people that wanted to be involved, they kind of like stepped forward and said, hey, I'd like to be more involved. Those that didn't are just passive. For this particular partnership, I mean, I don't want to call it a mistake, but it was a rookie move, was like 13 partners all equally invested, right? And so that creates challenges for 2 things. One, every time we close a loan or refinance, we have to get 13 signatures. And that's like probably the biggest pain in the ass that we've got as a group. The other is like, we're putting in a lot of work on the side, especially there's one person in particular in the partnership that puts a significant amount of work in, and his return is the same as everybody else's. And so this was really like a search and destroy mission for us. Let's figure this out, figure out a proof of concept, see if it can work. And then in the next round, we're a little more educated. We'll structure the company a little bit differently, make things happen and move a little bit quicker. So that's kind of where we're at today.
Okay. Like with regard to that signature and then the equity piece for everyone else, or what else would you do differently for anyone listening that's like, hey, I want to do this? Like what should they be thinking about?
When owning and operating an SFR fund, you want to separate out the management company from the fund that owns the properties. And we didn't do that. It's all one thing. So when you've got one entity that manages the portfolio, that's where all the work is. Putting in capital to buy homes is simple. You write a check and then there's typically somebody at the fund. But the management company, in today's world in SFR, they're helping acquire the properties on behalf of the fund. And so creating an entity for the fund with limited partners, and then a property management company or a management company that owns and operates the portfolio separately, it just makes a whole lot more sense. And that's really, shame on me. Like, I've seen this, I know this, but we just wanted to get going. And again, at first it was 5, right? So we weren't going to separate those 2 out. It was simple. It's like, we can get 5 signatures. But when it grew to 13, it became challenging. And so we'll look at that a little bit differently next time. Sure.
And have a separate management company, even though you all are leveraging a local property manager?
Yeah, because there's much more. I mean, you have to communicate with the management company. You have to go through the process of buying the homes and through due diligence, and you have to make offers, and you have to make sure your books are in order. You have to file taxes, and you have to sometimes raise more capital. You have to open up a line of credit so you can buy in cash and turn on refinance. We can talk about that as well. But there are a number of things, hidden chores, let's call them, that have to happen when you manage a portfolio. Even if you have a property management company, that property management company is going to help you place tenants and make sure your tenants are happy and residents are having a positive experience. Outside of that, they're not doing a whole lot. They might help you find homes. They might help you negotiate. They might help you with renovation. But everything around organizing the company, that's just, that's one vendor that you have as a part of the organization. You have your CPA. You have a bunch of different things you have your banker that you have to manage. Your property management company is not going to deal with your banker. It's just not going to happen. They're not going to go find a line of credit for you. Like, that doesn't work that way. So there are a lot of hidden chores that are in there that I strongly recommend, like, thinking ahead, because it doesn't take very many homes, very many investments to need to put a significant amount of time, even if it's distributed amongst partners, into the operation. It's not a set it and forget it. This is not George Foreman's grow. This is like, there's a lot going on here. You know what I mean?
Oh man, I don't think I've heard a George Foreman grow reference.
Now you have.
That's awesome.
Now you have. Or maybe it wasn't George Foreman. Maybe it was, what was that? No, it was a different one. It was an infomercial. Set it and forget it.
Forget
but
it.
It works with the George
that's
Foreman.
too funny. Well, Kori, talk about like the strategy, because you mentioned it just briefly about like line of credit, purchasing in cash, and then turning around and doing a cash out refi. So how are you purchasing properties, and how are you structuring your deals?
So up until now, and oh boy, are we headed for some news on May's real estate market. Like, people aren't going to believe what they read in terms of percentage swings. But up until now, it's been a very competitive market for buyers. I mean, like, you had to show up with cash. You had to show up with
No
more
contingencies.
cash, no contingencies, waive the inspection, right? All of these things that everybody in a healthy market will tell you, don't ever do this. You had to do over the last 2 years to buy real estate. In some markets, you've had to do that since 2011 or 12. I mean, in Denver, for example, and this is one of the reasons why we didn't come to Denver, but in 2012, my wife and I, visited a home, and we had to put an offer in same day, and we thought we were crazy, right? And we ended up closing on that house. It's now a rental, but we ended up closing at $332. It's probably worth $900,000, and there's a reason why, because Denver has been nuts, right? So the market's been like that since then. So what we decided to do is utilize a lot of the cash that the partners put in to buy the homes in cash, make cash offers. Promise a quick close because we had to win the properties. And then we would turn around and take the portfolio once it got to a certain size and refinance it with a bank. We have a great banking partner down in the Southeast, and they've been fantastic. But we've always historically bought in cash, turn around, refi, pull the money out. Oftentimes it'll appraise much higher than we initially bought it for. And I'm scared to say this because it sounds so 2009, but the bank is paying us at this point to buy these homes because we're able to leverage 85%. And so if they've appreciated more than 15%, right, they're like giving us cash to close on these homes that we bought in cash. Again, sort of scary to say, but in terms of rentals, like, we're not in danger. Like, they've performed fine. And as long as you cash flow through ups and downs in the market and interest rates ups and downs, it's you'll end up on top. But like, Denver is a crazy market. I mean, I remember I was thinking about getting a single family home to rent, like, separately outside of SFR Emo. I think it was like 2 months ago, maybe a month and a half ago, and I took my kids to the open house, and I showed up about 10 minutes early because I had to be at like a birthday party or some bullshit like that. And I get there 10 minutes before, and there are already eight groups touring the home. And I'm just like, still really, like, in this neighborhood, frankly, like, really. And so it took me one open house to say, you know what, I'm out of this market. I mean, I know this market, and a lot of the advantage that people will have is they'll understand the local market, they'll understand the neighborhoods, they'll understand where are they putting, new light rail stations in, where's their economic opportunity. But Denver was just too competitive, to stick around for. So
yeah,
it's been
that
crazy.
Makes a ton of sense.
So we buy in cash, turn around, refi, pull cash out, rinse and repeat sort of deal. And as long as properties are appreciating, it's a pretty good model, especially when it comes to rentals. Fix and flip, I'm not a big fan. I think, someone gets caught with their hand in the cookie jar at the end of the day with fix and flips. But as long as you're keeping and cash flowing, I think you're fine. And that's kind of been our model. And we're able to now take out a line of credit that's securitized by our portfolio. So even better, we're able to use cash from a line of credit, make sure that there's good cash flow, turn around the bank, refi it, pull the cash out, and rinse and repeat. And that's sort of what we've been up to. And you can keep doing this depending on how the market performs and how interest rates look. I mean, you can keep doing this for a while, right? Our goal, we're at 28 now. Our goal is 60. But depending if things continue to appreciate, then we could be even higher than 60, depending on how much the bank will pay us to buy these homes, basically. I'm afraid to say that. Should I be saying that?
I know. It sounds terrifying. But that's what I wanted to ask you. So did you say they're financing 85% loan to value?
Yeah.
That's like unheard of in the investment property space.
You usually hear 75-25. We found a bank that's pretty aggressive. I mean, it's not like a small lender. It's a bank. It's a legitimate bank. And they've been a great partner for us. I think they see the opportunity and they're a little bit of a risk taker. They're keeping these loans. They're obviously not selling them to Fannie and Freddie, I don't think. But we've also got so many partners to fall back on. Like it's not risky for them. You know what I mean? When you have that much wealth behind the partnership, and I'm not talking about the individuals, I'm talking about as a group. Like you've got 13 households where if something goes wrong for some reason with the majority of the portfolio, like they'll be fine. So I think that's also potentially why they're able to leverage so much. But they also are bullish on the rental market and SFRs, and they understand, SFRs. You go to a bank, let's say up in upstate New York, they just haven't been around SFR very long, so they might not be as accommodating and as flexible. But in the Sun Belt, I mean, banks are trying to monetize this just like every other individual investor. And so finding the right banking partner has been, really great for us and strongly recommended. I mean, that's one of the most important things. We've gone through 2 banks now. We were with a credit union before. They didn't really see the vision that we had, but now we're with a private bank and it makes a lot more sense.
Okay. Well, that's great to know. And I'm curious, when you started putting this all together on paper, that was 2020, 2021. I mean, interest rates were at 3, 4, maybe sometimes even in the 2s. Now they're up in the 5, 6, 7s. Has that changed your model much or really changed the performance of what you were expecting return-wise?
Well, yes, of course, right? Cost of capital it's real. It's a real thing for individual investors who are buying their primary home. It's a real thing for smaller investors, family office, all the way up to the REITs and the institutional landlords. So everybody's feeling a squeeze with those interest rates. Cost of capital obviously going up, cap rates being compressed. I think what we'll see and what we've seen historically is that rents keep up with interest rates, right? So we'll see, rents have gone up, I think, year over year, 16%, I believe, in SFR. We'll see those continue. Fact check that before you post it. But I think I saw that in the Wall Street Journal. And so rents kind of keep up. And so that's, we have that to look forward to in terms of paying more for capital. But also, the goal is to cash flow through the periods, through the ups and downs, right? Through the different markets. And SFR investors, you'll see, we borrow at 5 and 7 year 7-year loans, right? So we're not in it for the 30-year fixed. And so that should take us through any sort of period, right? We should be able to refinance within the next 7 years. Again, hearing things from 2008 kind of reverberate in my head, but that's the idea, is that as long as you can cash flow through interest rate periods, you should be fine. And as long as rents hold up, which we don't see any reason why they shouldn't. I mean, we're, again, 4.5 million homes short of supply right now. Supply is not going away. Now, home values have gotten to a point now where buyers have said, we've had enough. We're not doing this anymore. Besides the fact that we can't afford it, right? Like, between the interest rate hikes and the appreciation of home values over the last 2 years, we're talking about a 43% increase in cost to pay a mortgage. Okay. Like that's insane. So
compared to when? Do you know?
2 years ago.
That's wild.
Compared to like beginning of 2020. I mean, between the appreciation and the interest rate increase, going from like 3 on average to 5, whatever and a half, will reach 6, 43% more expensive to make mortgage payments today. Now, the good thing for SFR and for rentals is people are still, there's a high demand for spacious, professionally managed homes, right? Single family rentals. And that demand isn't going away. So when people can't necessarily afford today to buy a home, or maybe say, hey, I'm going to sit on the sidelines for a couple of years because this is batshit crazy, they're going to rent, right? And so the demand keeps up, the rents keep up, inflation continues to go up, and hopefully we'll see that slow down here due to the increase in interest rates. But, cash flow is important. I think it's been proven over time in history that rents will keep us cash flowing. And that's why the industry is so attractive and so new still. We're only a decade into this being professionally managed, right? Landlords been around for before we can remember. But there's an appetite for professionally managed properties so that the experience that I'm going to have as a renter, as a resident, is on par with if I owned my own home and was able to do whatever I wanted to do to my home. Now I can have that luxury of having that home, but having it professionally managed. So if things go bad, I can just call someone. They'll be here soon to fix it, right? Or if I want to move, it's not that big of a deal. My lease ends, I go find another lease.
Right.
So that demand isn't going away. And that's what's keeping us so strong as an industry. And I was just at the National Rental Home Council conference in DC, and that's kind of the theme, is that, everybody's cautiously optimistic because it's a weird time. There's a lot of uncertainty right now in the economy, but there isn't a whole lot when it comes to our industry. And so I think, again, when is it a good time to buy? In my opinion, always. So what's happening right now is interest rates are going up. Prices are still going up. We are seeing, I think a Redfin report came out today that prices are starting to come down actually. And so there's a huge opportunity for investors to get into the market right now and buy. And investors don't have to buy at list price. It's been only a month, but the whole thing's been flipped upside down. So what I'm telling my acquisitions team, is this is a time where, frankly, you go in and you offer 15 to 20% less than what it's listed for. And you offer on volume all of a sudden. And then those that are willing to get out with a cash offer today, those are the deals to be had. And yes, you are paying a higher interest rate right now for that. But you know what? If you get the deals, and I'm not saying you'll get them at 20 or 15% discount, but you'll get them. You don't have to pay list price today because the market just hasn't adjusted down to the interest rates that we're at. Mm-hmm. There are some steals out there. And so it's a volume game, right? It's like going to the bar and meeting men or women, right? The more you ask, the better chance you're going to have to succeed. And it's the same with real estate today. The more offers you throw out there that might be less than what they're wanting or hoping for a price, some are in a situation where they need to exit or want to exit. Mm-hmm. And so there are opportunities out there more right now than ever in SFR, which is crazy to think about.
That is crazy to think about. And so you mentioned there are some big news coming out. Was it the Redfin report about where you think prices are going for the May report?
No, I mean, there was some information out, but they're still reporting on April. This is just, my prediction is
your crystal ball.
My crystal ball tells me, based on various different data points, that May will be the biggest drop in transactions we've ever seen. The biggest drop in transactions month over month that we've ever seen. I'm predicting. I'm putting it out
for May 2022.
May over April and May year over year. Also, that will be the biggest drop in housing starts as a percentage, mm-hmm. and let's say closed transactions will be in May. That'll continue into June because there's always a lag. Housing starts we get at the beginning. Contracts to buy new construction we get at the beginning. So that's always an indicator, a leading indicator of where the market's headed. But we'll see that as built, or already built existing home sales, they're just going to plummet right now. And that's because there's pretty much going to be a standoff between buyers and sellers right now. I mean, when do you remember seeing homes drop in price in Denver?
Right.
I don't remember when that happened.
Yeah.
So I think the buyers are fed up. I think that affordability has gone through the roof, And I think that the Fed is going to succeed in stalling the economy, installing the housing market, which has a trickle-down effect to the rest of the economy, right? I mean, think about movers, Comcast, right? Any sort of cable television, Home Depot and Lowe's, right? All these companies that we don't really think about, or Amazon. People buy stuff for their new home. Like, the Fed wants to slow the economy down. They're definitely going to succeed. We're going to see some job loss from it, but at the same point in time, this is an okay adjustment to the overall market and the housing market. We know that this is not sustainable. We said that a year ago, a year into this crazy rocket ship ride. So we'll see a slowdown, and it's healthy. It's okay. And that also creates these deals that I think are definitely still out there. There are still motivated people that need to sell for one reason or another. Maybe they have to move. Maybe their adjustable rate mortgage is up, right? Maybe they set it 7 years ago and all of a sudden they're having to refinance and it doesn't make sense. Maybe they just feel like they want to cash out and it's time. And so, those who went under contract, let's say a month ago, kind of probably hit the top, but for the short term, but there's still a lot of opportunity out there to get some good deals right now.
You heard it here first, folks. That's awesome. That's awesome. All right, well, Kori, we got to get you out of here, man. Thank you so much for coming on again. For people that want to reach out to you, connect with you, learn more about PlanOmatic, where's the best place for them to do that?
LinkedIn is great, although my name is hard to find. KoriCovrigaru. I'm sure it's in the post. LinkedIn's great. My email, Kori@planomatic.com. I'm always fielding emails, so send me an email. And otherwise, I'm not really on Facebook or Instagram or any of those. So
okay,
email and LinkedIn is probably best for me.
Right on. That'll have to do. Well, Kori, thanks so much, man. Appreciate you coming on again. We'll chat soon.
All right. Thanks, Michael. Great to be here.
Be good. All right, everyone, that was our episode. A big thank you to Kori for coming on and sharing with us what he's been doing in the space. As always, if you like the episode, please feel free to leave us a rating or a review wherever it is you get your podcasts. And we look forward to seeing you on the next one. Happy investing.